Hello and welcome to episode 307 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leakes. Damien, welcome back. How are you doing this week?
I'm good. I know I say that often at the start of these podcasts, but I am, and I'm really buzzing about the stuff we're producing on the site, and some of that is appearing on the podcast. One piece, in fact, you're going to do today, Andy. I won't let the cat out of the bag just yet, but I think what is really exciting as we're building the team at Money to the Masses, and we are looking to recruit some more people as I sort of say this, but the content that we produce is better than anything else that's out there on the internet, and that's not being boastful, but that's the mission of what we do. And it's so good to see the stuff that is being produced, whether it's around investing, whether it's around bank accounts, pet insurance, mortgages. The level of what we do is brilliant to see, and the quality of the stuff that everyone at Money to the Masses is producing is top notch, I have to say. And I've been doing this for more than a decade, but it's really exciting to see, and the feedback from listeners and people who read the podcast, emails we get, is fantastic to receive, because not just, as Andy and I say, from a sort of morale boosting point of view for ourselves, but it just reinforces that we're hitting the right spot. And actually, we do share your feedback to the rest of the team, and it is really motivating for somebody who is writing or producing content in the background to get that feedback. The stuff they're doing is making a difference. And we've had examples, which I won't go into on the podcast, of where we're actually making changes within industries who are having to react to the stuff that we're producing out there, because obviously we identify things that aren't right and things that need correcting. So it's exciting to see, Andy. I am absolutely buzzing. It's good to see Money to the Masses is really pushing on, and we are seen as a real player in this market now.
Yeah, it is hugely exciting stuff. I genuinely feel privileged to be part of that process. And like you say, making people have to stop and think about the products that they've got, and are they actually up to standard? Are they good enough? And when we dig under the bonnet and we find it, it's a huge motivating factor to help consumers and obviously the listeners of the podcast to get better products. So I suppose moving on to this week's podcast, what have we got coming up on this week's show?
One of the pieces is kind of derived from some commentary, some press commentary that I gave this week. So, as I say, we have a lot of influence, and people will see me often in the weekend newspapers. It was The Guardian this week. But I get asked for my view on a whole range of topics, and particularly investing-based topics at the moment, because investing's in the news, and it's around speculative trading that I was asked of you this week. So one of the pieces on the podcast this week is about CFD trading, contracts for difference. I want to explain to people what it is and the risks around it. Of course, it would be balanced with the positives, but we need to understand what these things are, because people are starting to engage with CFD trading, and I'm a bit concerned. The other thing I want to do is something called Geoarbitrage. Now, if you don't know what that is, it's something that could be used to speed up your journey to perhaps retirement or financial independence, and potentially boost your happiness. So that's something to look forward to. And finally, Andy, I'm going to be handing over to you to talk about.
Yeah, I'm going to be talking about business accounting software. Now, that might seem a bit strange, a bit off-piece for what we normally do, but actually, we've just had the tax deadline on the 31st of January, and there's been some stats that have come out that have said how many companies have been created this year. Obviously, we've had the pandemic, so there are loads of new businesses out there. And as a result, we've had lots of queries and questions that have come in to Money to the Masses asking about setting up new businesses. And one of the things we've been asked is business accountancy software. Is it any good? Which one should I go with? So I've written an article, and we're going to cover off the main pieces in this week's pod. Okay, let's move on with the investing piece to start with. Now, you're going to be talking about CFDs. They've come to light in recent days and weeks, Damien. What are they?
Right, so CFD stands for Contract for Difference. And the reason this came to light, and I've been asked about it by the press this week to make comment, is because of the speculative investing that's been going on in investment markets. So if you've listened to Midweek Markets, you would have heard me talk about GameStop, the crazy price rise, and since it's been a bit of a collapse in that share price, driven by retail investors. So that means armchair investors who are using forums like Reddit, or they might even be using social media platforms to take or get advice about investing, or in this case, it's really speculating on markets. Now, there is a difference between investing and speculating. Investing is very long term. Speculation is where people just try and pretty much get rich quick. And I mean, there are people who do it for a living, where they will be speculating on prices of assets, etc. But for most people who suddenly come across it and start to get involved in things like trying to ride a crazy rally in a particular share price when they've had no previous experience of investing, that's speculation, and that's dangerous. So the reason that I'm talking about CFDs is because one of the ways that people do this and try and get rich quick and make money is through using a CFD. So a CFD, as I said, is a contract for difference, and it's basically a financial derivative that allows people to speculate on rising or falling prices of assets. So that could be shares, so shares in a particular company. It can be commodities, it could be currencies. But the key thing is you don't actually have to own the underlying asset. You don't when you use a contract for difference. So it's a sophisticated investment product, but it is readily available to armchair investors. So you can go quite easily and get a CFD account and start using these. So what I want to do is explain how they work and what they are. So CFD trading works by you either buying or selling a CFD contract. So if you trade a CFD, you basically enter an agreement where there is an exchange in the difference in price of an asset from the point you buy it, so when you take out the contract, to the point where you close it. So it's effectively betting on the movement of the price of a particular asset without you actually owning it. So how that works is that when you go and buy, so you go into, say, a CFD trading platform, and you have an account, what happens? You can, for example, if there was a share of a company that you liked and you thought was going to increase in value, you can go and buy a CFD contract. So you basically go long. So you're betting that the price will rise. Conversely, CFDs allow you to short a share price. So you can sell a CFD, which means that you bet that the price of the share is going to fall. That's different to when you invest in shares normally, because when you invest in shares normally, what happens is you will buy shares in the company. So you own the asset, but you're effectively hoping that the price is going to go up. You can't bet that it goes lower. Do you know what I mean? If you buy a share, there's no benefit in it falling to you. So CFDs allow you to benefit from the movement in prices both ways. You can bet long that the price is going to go up, or you can go short. And what happens is when you go and buy a CFD, you will be presented with a buy price and a sell price. So that will be, let's say it was a share in Apple, for example. You will be quoted a price to be able to buy if you're basically wanting to bet that the price of Apple shares will go up. So there will also be a sell price. So that's if you want to sell a CFD. That's the terminology they use, where you're betting that the price of Apple is going to fall. Now, those prices, the buy and sell price, there's a difference between them. There's a small spread. And that is effectively how the CFD is paid for. So if the platform makes its money. There are commissions that you have on share CFDs, which don't tend to always have this spread. But what you've got to think, there's a market price, so what the price of maybe an Apple share is. Then when you use a CFD, there's a slightly different price. It's a bit above the normal market price, which will be the buy price of the CFD, you betting the price of Apple shares will go up. And there is a sell price, which is a little bit below the market value, the normal market value of an Apple share. And that will be the sell price where you're betting the market will fall. So the other key thing to know about CFDs is they work on leverage. So that means that you effectively borrow money to be able to make this bet, to be able to profit potentially or lose on the movements in Apple share prices. So a standard trade, let's say you liked Apple, you thought that the Apple's earnings were going to be stellar, the share price was going to go up, everyone's going to be buying more and more iPhones. What would happen in the normal case is you would say, I like Apple, I'm going to go and buy Apple shares. So you would say have £1,000 and you would go and try and buy £1,000 worth of Apple shares. So that means there'll be a price which you will go and pay, and it will dictate how many shares you actually get. So you will normally get like whole shares. So you'll have a X amount of Apple shares. I'm ignoring the real price of Apple shares in this example. So that is basically how it works if you want to go and own Apple shares. But of course, technology and the evolution of investing means there are now multiple ways in which you can benefit from the movements in share prices, and CFDs is one of those. Now, what happens with CFDs is you can use leverage to gain exposure to a much bigger sum of Apple shares, but using the amount of money that you have. So when you buy shares normally, you have to pay the full value of those shares up front. With CFDs, however, what happens is you use margin. This is the terminology you will hear. So a market, let's say it was the Apple shares, they might have a 20% margin. What that means is that you would only have to put down 20% of the value of the shares that you are having exposure to. So let's say in that example, you had that £1,000. What would happen is you would use that £1,000, and in a CFD contract, if you bought a CFD contract and you buy a number of CFD contracts which relate to that product. So let's say it was 100 Apple shares, it would likely be that you would have 100 CFDs you would buy. In each market, you will know how many CFDs relate to whatever it is you're trying to buy. And so in doing that, your £1,000 would be the equivalent of being exposed to £5,000 worth of Apple shares. Does that make sense?
Yeah, no, absolutely. That does make sense. Yeah.
So why people get excited about CFD trading, and it can seem like a get rich quick idea, is that you can benefit from almost effectively having a really big portfolio that is much bigger than the amount of money you really have. So it suddenly becomes attractive to people who are suddenly trying to make money, because they could, for example, GameSpot that we saw the other day, that particular share, they may not have lots of money, but they may have £1,000 in their savings account. In theory, they could take that money and, using leverage, could bet on the share price of that particular stock going up, but have that multiplied up at a very high rate. So it could be almost like 5 times, like I said, an example. The actual rate, that 20%, it varies from market to market. It can be as low as, say, 5% margin. So you can see the potential for larger profits and larger losses exist. So you will hear terms like trading on margin, or you read those sorts of terms, and that is basically talking about the leverage. So when we say that the margin, if in our example you had a small deposit that was leveraged by multiples of 5, then that margin is this small deposit you have, but and it's leveraged up to give you that greater exposure. But it can also mean, when you're trading on margin, it can talk about the amount of money that's required not only to open the trade, but also to maintain it. So there are 2 types of margin. There's the deposit margin, what you open the trade with, and there's this maintenance margin that exists, which is effectively an amount that's paid if you're close to making a loss. And the deposit margin and other funds in your account won't cover that potential loss if it grows. Then what you can get is something called a margin call, where you're required to put more money in, and if you don't, then the trading platform can effectively close out your position and therefore crystallize the losses that occur. So already you can start to see there is potential here for things to go wrong. Now, when you trade in CFDs, depending on the market you go into, there are rules around the level of leverage, like I mentioned. It could be, there's rules around the number of contracts you have to buy, the minimum amounts. Most of these trades don't have a duration on them, so there's no sort of fixed end point. You normally close them out by effectively making a bet of equal size, i.e. number of contracts in the opposite direction. So to give a brief example, if, like I said, you wanted to buy Apple shares, and I'm going to make the numbers up just to make them easy to understand. If the price of Apple was trading at £10, yeah, I know it's not, but if it's trading at £10 in the real market, and you wanted to buy 1,000 Apple shares, ignoring trading costs, etc., let's just keep it simple. To buy 1,000 Apple shares, you would need £10,000. You'd have to have that up front, and you'd own those shares. They'd be yours. With CFDs, what happens is, rather than the price of Apple being £10, if you wanted to buy a CFD, so you bet the Apple share price is going to go up, then the price you pay will be, for example, it'll be £10, but with like a half a penny difference on top. And equally, if you wanted to bet against it, the price that you sell the contract at, so the sell the CFD, would be just below £10. So it would be like £9.99 and like half a penny. So it's tiny differences. Now, you can see there, if I make the rule of this trade to be that you only need 20% of the value that you're trying to buy. So therefore, for this case, the margin, if you wanted to buy 1,000 shares, and based on the prices I've said, then to get the equivalent of £10,000 worth of Apple shares, you only need about £2,001. And you've got the leverage through the CFD to effectively have exposure to £10,000 worth of Apple shares. So it's 1,000 shares you're basically giving exposure to. That sounds great. So let's imagine the share price of Apple goes up 4%. So 4% on £10,000. If you own the shares, well, that is £400 effectively on paper. If you were then, but you'd have to obviously crystallize and sell those shares to actually get that profit. Of course, in the CFD world, you've only put up £2,000 just over because of that margin difference. That's why it's a little bit over. But you've put up £2,000. With the Apple share price moving up 4%, you effectively, when you do the numbers, will make about £390 profit. Yes, there's commissions, there'll be maybe other fees, but we're just broadly talking, you make that amount of profit. But if the share price falls 4%, you will make just over a £400 loss, obviously, on paper if you own the shares, but you would do on the CFD too, because you've got exposure to 10,000 Apple shares effectively, but you've only put down £2,000. So you can see how the dynamic works. But in reality, going back to the start of that example, let's say that the person said, right, I have got £2,000. I'm going to make a CFD bet that the price of Apple shares will go up. I'll use my £2,000, gain exposure to 10,000 Apple shares. The price goes up 4%. I've made nearly £400 profit. Brilliant. But in that example, if the share price falls, like I said, they will make just over a £400 loss. If instead they'd only had that £2,000 and they decided that they were going to buy Apple shares, then they would have only been able to buy £2,000 worth of Apple shares. In that instance, if the share price had gone up 4%, then they would have made £80. But if it fell 4%, they would only lost £80. So you can see that if there's two people, one person A with £2,000 who buys the shares and the share price falls 4%, on paper they've lost 80 odd quid. Person B who thinks they're really clever and uses CFDs with their £2,000 and goes and bets that Apple's share price will go up and it actually falls, then they're sitting on a loss of £400. That's a big difference. Now, if the market had been a slightly different rules, and rather than me saying you only had to put 5% of the money up front, rather than the 20% in my example I just gave, then the loss for the person who went down the CFD route and the share price fell 4%, that's not much, 4%. It can happen quite easily if you get a bit of bad news or over a period of time. It doesn't have to happen in one day. They would be sitting on a loss of £1,600. So that's very different from person A who bought Apple shares and had his £2,000 in Apple shares and is sitting on a paper loss of 80 odd quid. Because person B used CFDs with huge levels of margin, they are now sitting on a loss of £1,600. So they're going to get, basically, if they crystallise this, only about £400 back of their money. Now, this is the problem with CFDs, and this is why I don't like them, and this is why I want people to understand how they work, because people often only talk about the upside, and all the traders and people who talk on Instagram, and they all give you this impression that they get rich quick. Yes, you can get some big wins, but it's effectively, to my mind, gambling. You are gambling on a share price using leverage that amplifies that. But that can work the other way. And to emphasize that point, 75% of retail customers, so armchair investors like the rest of us, all of us, lose money when they do CFD trading. And the FCA make the trading platforms like IG, like eToro, like trading 212 have to put that warning on their site, but that obviously doesn't stop people still going down there and speculating and trying to make money quickly. So they are the dangers of CFD trading. So I want people to be well aware of it. And my advice would always be to steer clear. I wouldn't do it personally. Now, of course, we are a world of adults. We are a world of people of mixed abilities, and some people can understand the risks. And there were people who use CFD trading perhaps for what it was intended for in a more diversified way, because it enables them to gain exposure to some other markets, because there are some obviously positives. They don't have to own the asset. They can use it to hedge their portfolio. So, for example, if you had a portfolio of shares that you physically owned and you were worried about something that was about to happen in the market that could cause that share price to collapse, one of the particular stocks you hold, you could use CFDs to effectively bet the share price would fall. And you could do that with a relatively small amount of money using leverage. So if the share price did tumble, then your CFD would effectively be in profit, and you could use that to offset the losses on the shares you actually held, the share price had fallen over there. And of course, if the share price didn't fall, you would close out your position, because don't forget, you close positions by betting in the opposite direction. So that is why CFDs can be used and can be useful for people, but it's a very sophisticated thing to do. It's very different to investing. It's down the speculating route. And I mean, there will be people who highlight things like, if you go on the platforms, they talk a lot about the fact that you don't pay stamp duty, etc. And the markets are open all the time, but that can actually work against you. So that can mean that the market is open and suddenly you get a margin call because the market has suddenly moved against you, and they closed out your CFD trade effectively, and you crystallized a loss. Yes, there are things called stop losses and limit orders. That's all great, but it's very sophisticated. So my message from this piece is avoid CFDs. Understand what they are. That's good. Everybody should understand what these things are. So when they're at a barbecue and somebody says, oh, I've got a CFD trading account and I've been making a killing, what they're doing is effectively borrowing money to bet on something. And if you don't understand a company well enough to want to own it, in my view, and hold on to those shares over a longer term, I mean, why would you want to place a bet for the very short term on the direction of travel of those? So this is a problem that we've got in markets, that people are being drawn into CFD trading. The press has a responsibility to stop fanning the flames. People are going and getting information from the likes of Reddit, from social media platforms, and that is again partly because of the advice gap that exists out there and the lack of education. So people don't understand how these things work and get into them, and they have a friend who does it, who talks about how much money they've made. It's exactly like gambling, Andy. You know people who talk about their winnings, how much money they've made. They don't tend to tell you about the losses. And I am really worried, genuinely concerned, that what we've seen on the GameStop share price that rallied ridiculously in the last couple of weeks, that was pushed higher and caused a short squeeze, which is something I've talked about before on the podcast, and they were trying to almost bankrupt hedge funds. There will be people who piled into that later on, and now the price has started to come back, which it inevitably was going to, then they will be sitting there seeing their losses amplified. They went in there, tried to get rich quick, and they've lost all their money. And the problem is, when people put life savings into these things, they have overnight could almost lose their money. So it may feel like a bit of a scare piece, and I'm quite happy that it is. There are people out there who do use them, and they will use them sensibly. Good luck to them. But do avoid them if you can.
Good. I mean, you say it is a bit of a scare piece, but I think someone needs to say it, Damien. And you have picked out some plus points as well. For instance, I'd never thought about CFDs as almost like an insurance policy on your normal stocks, which is a really sensible point and kind of makes sense. It's where you can use them to your advantage sensibly. No, I think that's a good balanced piece, and like I say, there's nothing wrong with highlighting the pros and cons of these things.
And sorry, Andy, just one final bit before we move on. If people want to change the world, and we talked about activism in shareholding before, so you get voting rights, etc. If you buy shares, you don't if you own CFDs. You're just trying to make a quick buck on movements in share prices. If you own a share, you can influence a company and what it does, and that is important to a lot of investors. So anyway, Andy, we're moving on. What's up next? Oh, it's actually you, isn't it, Andy? It's your piece on accounting software.
Yeah, I'm going to do a quick piece on accounting software. As I say, it's a bit different to the normal things we do, but there is a tie-in. There are lots and lots of new businesses that have started in the last year. In fact, the numbers are quite staggering when you look at them. In 2020, there was an additional 85,000 businesses that were created when compared to 2019. Now, that's an increase of 12.3%, which is the highest percentage growth for 10 years. And it's actually the highest growth in numbers, in number terms, on record. Now, it doesn't take a genius to work out why that is. Obviously, we've had a worldwide pandemic. It's caused massive casualties in terms of employment. So people are going it alone, starting out on their own, which I think is great. We've done a podcast, Damien. It's called The One Giant Leap, if anyone wants to go and seek it out, where we've talked to people that have taken this step. They've got a passion for something and they've gone and created a business off the back of it. So kind of running with that theme and having been contacted by quite a few people saying, look, I'm starting out in business. Where do I start? We're going to be writing a few articles around this theme, and we'll probably cover it in a podcast in future weeks about checklists, what to do when you start a business. But I thought I'd drill down on one particular part of starting a new business, and that's looking at accountancy software. So if you are a new business, a small business, the first thing to consider before you get any accountancy software is work out whether you actually need an accountant itself. It makes sense to have one. Obviously, new businesses, there might not be a lot of cash flow. You might not be able to afford it, but there is nothing wrong with purchasing accountancy software, which we'll go into in a second, but also having an accountant as well, because the two actually link together quite nicely, and there's nothing wrong with having both. So, accountancy software, what is it? Well, there's a number of online platforms out there that will provide, I mean, they call it software, but really it's cloud-based. Software to me always means something that you download and have on your system, but most of these platforms that you will sign up for now are online. They're cloud-based, everything's secure and kept on the cloud, which is great for you as a business because it means you can do things on the move. You can do it from your tablet, you can do it from your mobile phone, and it seamlessly interacts with your business bank account, and it's great. So let's look at the costs of accountancy software. You might think it would cost a lot of money. It honestly doesn't. Really, what you're looking at, for a basic package, you're looking at about £10 a month for your business. Now, that £10 a month will mean that you can have access to this software 24/7. It can, again, like I say, link to your phone, and you can sync up your business bank account. That's the great thing about it. You can let it go and do its thing. It's an automated thing that will link to your business bank account, your business credit cards, and it will start to reconcile your transactions automatically for you. You need to do a little bit of setting up initially. You set up your account, you set up your payments and where your money comes from and all of that kind of thing. So it will take a couple of hours to get used to it. But once you've done that, honestly, it is so efficient. You can also use this software to snap and save your receipts from your mobile phone, which again is going to reduce the amount of paperwork. You're not going to lose your receipts. Again, efficiency is key. So it's about £10 a month for a basic package. You'll be looking about £20 to £25 for an intermediate medium package. And I'll go through what the packages essentially mean in a second. And the Rolls Royce of packages are only going to set you back about £30 a month. So for £30 a month, your business is going to have access to some seriously powerful software. In the article on the website, which we'll link to, I actually go into more detail on the individual accounting packages themselves. I've looked at FreshBooks, I've looked at QuickBooks, Sage, and also Xero.
I mean, I have to just jump in there. Sorry, Andy. I've seen this article, and this is one of the reasons I was sort of going on at the beginning. It is really good. It is in depth. You would very quickly better see which one is good for you, effectively, based on your business. And I just want to back up something Andy said at the beginning, that if you're thinking about starting a business of some kind, then one of the best things we ever did at Money to the Masses was obviously the accounting software, because what it really does is stops the days of having big box files of invoices, banking statements, receipts, which you've got to reconcile at some point for whether it's VAT or when you get to the point you've got to pay tax. Because it's doing all along the way, you're literally then having to reconcile electronically very easily, that it makes the job almost seamless. The adverts you see on telly, it isn't a million miles from what they actually show, in fairness. And the bit that Andy mentioned about the receipt, brilliant. I've done it. We use it. Take a photo, save the receipt up. It's evidence of what you've bought. You don't have to have all necessarily the paperwork and stuff, and it will just be able to, again, be reconciled very quickly when you sit down. And the other thing, I just want to, again, back up something Andy said. Having an accountant is one of the key things. When we do the checklist, actually, in future, one of the key things I'd say for anybody to do, accountants don't become more and more expensive the more money you make. It can seem a large outlay at the start, but the time they save you is worth the weight of the money you pay. I mean, you will save a lot of money, time and heartache if you have an accountant, but the two sync up. So rather than you having to sit down with your accountant and go through lots of stuff, if you have these software packages, and I think I might just be about to steal one of Andy's points that he comes on to, I have seen the article after all, is that you can link up your software package with your accountant and they just go in, do your books and everything for you from that software. So it's a key point, isn't it, Andy, to check if you're going to have an accountant and they're worthwhile. Accountants cost you maybe a total of $2-3 a year. It depends on the services you need as well. It can be a lot less than that. But what software they use in the background is important, because if they use, for example, Xero, then it's easier to use an accountant that is set up to use that software and draw down from it.
Yeah, absolutely. It's a key point. If you've got an accountant, speak to them as well. Maybe speak to them first before you even go down this road to say, look, do you know which software packages there are out there? Which ones do you use? Which ones do you recommend? Don't forget, they'll have hundreds of clients likely that all use different packages. So they will have exposure to those and were probably best placed to give you advice. And so we mentioned before about the basic and the intermediate and the premium softwares that you can buy, roughly between £10 and £30 a month. It's worth looking at each individual one for what's best for you, but I've actually made that a little bit easier for you in the article. I've broken it down on what accounting package offers what within each subscription level. So typically on a basic package for about £10 a month, you're going to get your cloud-based accounting, you're going to get the connection to multiple bank accounts, and you're going to be able to capture your bills and receipts. If you move on to the intermediate package, you're going to get extra bits and pieces like being able to work in multiple currencies, have unlimited users on your account. And then if you go to the super packages, the premium packages, you'll get extra things like mileage tracking and potentially payroll and things like that added on top, and CIS returns, which is to do with the construction industry, which is quite a complex thing that actually is really good value if you can get it in your accounting package.
So one of the key things then is that you need to sit down and work out what your business does and where it's potentially headed when you're thinking about the packages. That point you made about the construction industry, or even if you're going to plan to have employees from the beginning or not, that will dictate probably which package you look at, won't it? Because some of them will charge more or don't have that service.
Yeah, it's a really important point, because some actually don't have that service at all. So if you're going to be employing people in the future, you don't really want to be stuck with a package that can't facilitate that in the future. Just a quick one that I didn't mention before is if you're a really fledgling business and you're really just starting out and cash flow is really tight, there are free software solutions out there. There's a company called Wave that offer cloud-based account. It's very basic, but it will give you what you need if you're a very small fledgling business. Just to wrap this one up then, Damien, I've gone through and kind of worked out which package might be best for various different types of businesses. So if you're wanting an accounting package that's just good value, good plain value, you're looking at cost, I would look at probably QuickBooks. If you're looking for something that's really easy to use, I would possibly move over to FreshBooks because it's really, really simple. The reviews on FreshBooks aren't brilliant, so do have a look at the reviews before you go in. But if you want something simple, FreshBooks is really simple. If you're a business that's going to be doing multiple invoices and you want to be able to really drill down into the invoices and change them, QuickBooks is the best one for that. If you are a business that's probably looking to go down the payroll route in future, Xero is by far the best that I've looked at. If you're looking at something that is going to provide you with really good customer service, assistance, telephone helplines, someone to walk you through the setup process and things like that, then Sage is the best one that I've found, because they've been going since 1981. They've got over 13,000 employees, and honestly, the reviews on Trustpilot are just out of this world. So that's it, really. That's the roundup of the accounting packages. Check out the article I've done on the website, and we'll also link to that in the podcast notes.
So I think that's a brilliant piece, given a lot of value there, because Andy has spent almost an entire week analysing all these packages because no one else has done it out there to be able to allow you to quickly decide which would probably be the best one for you and your business. So you go and look at the article, obviously you listen to the podcast, and you can apply it to what sort of business you're thinking of starting, for example. Moving on to the last piece, Andy, Geoarbitrage. Have you ever heard of the term?
No, but I think I've got one of his recipe books.
Such a bad joke. Right, no. Geoarbitrage is a term. Well, actually, I'll tell you what, let me start it a slightly different way. When we all go on holiday, which is something we used to do in years gone by, we've all forgotten what even a holiday is. You remember we used to get on planes and we'd go to another country and we'd sit there and think this is fantastic. And we would talk about how strong the pound was and how things seemed cheaper when you were abroad. Okay.
Yeah.
That was a great feeling. You'd go somewhere and you'd be able to buy things and people come back going, telling you how cheap maybe the clothes were that they bought or food or eating out.
Yeah.
And you're incredibly jealous. And equally, on a slightly more depressing note, something that a lot of us used to do before was commuting. And with commuting, we would all be paying to travel, particularly in the southeast. I mean, it happens around the country, but if you don't live in the southeast, around the sort of home counties, particularly places like Kent, people will spend an hour travelling into London and standing up on packed trains to be able to go up there and earn more money. And the wages are a bit better in London because of the London waiting, and they commute back down to where they live. And it's a not particularly great lifestyle. And what we've all realised now with working from home and lockdown is, do we really want to do that? Now, those two examples are quite different, but what they start to highlight is the ability and the attraction and the benefit of being able to be mobile. And more importantly, something called Geoarbitrage. Now, this is a term that Tim Ferriss, if anybody's ever read the book, The 4-Hour Working Week, it was a well-known book that was an international bestseller, which was basically him saying you could only work 4 hours a week and do what you want for the rest of the time and still have lots of money and you travel, etc. And
our podcast listeners, Damien, will be very aware of Tim Ferriss, I'm sure, because if they're into podcasts, you cannot move for seeing Tim Ferriss in the business and finance section.
I don't know how he's in the business one as a slight sort of question, because he always is number one, but I don't think he's necessarily business. But anyway, interesting podcast. Go listen to it if you don't. But one of the things is that Geoarbitrage is this concept whereby you could, for example, earn money in one place and you might spend it in another where it is you get better value. So a good example of that is that obviously when you went on holiday, you've earned money in the UK and you could go to a country that is got a weaker currency and it might be a developing country and you can buy a lot for your money. Particularly in places when people talk about, go to Thailand, how much you can get for your money. That is all part of this idea of Geoarbitrage, the fact that you can benefit by moving location. So the commuting concept is a similar kind of thing. You live in one location, but you move to another, earn more money, and you go back to where you obviously live, where housing might be cheaper. You can buy a cheaper house. The problem is that arbitrage doesn't work so well because you're paying a fortune to commute. But this idea of geo-arbitrage, people don't realise that they may be thinking about it and trying to exploit it now, and it's come to light because of the coronavirus pandemic. Now, in London in particular, there is a phenomenon that's occurring whereby people are moving out of London into places like Kent, into places like Surrey. They're moving much further away and even further afield. I know people who've gone much further north because they are able to work from home now. The employers allow them to do it. The computer software, etc., and infrastructure is set up. They work from home. Why do they need to live in London or near London even? And so what we're seeing is a movement of people going out of London and living in these counties further away from central London because they can get a much bigger house but pay no more money for a bigger house, and sometimes they actually pay less. So they actually release money from their own house and have a mortgage that's perhaps even smaller but have a much bigger house. And there are people listening to this podcast who I know personally who have done that. People are now realising this. So we've had about the stamp duty holiday that's been occurring, and there's lots of talk about whether it be extended. But I've heard anecdotally from estate agencies around London where they're actually seeing still a strong demand for property purchases because of this flow out of London. And when we did our property piece not long ago, we did a live event based on mortgages, for example, and the property market in the pandemic. That trend came to light. So people might not realise that they are thinking like this to try and geo-arbitrage. But the point is that you can deliberately do this now. So you can sit there and think that you would decide, look, I can now live and work anywhere. Why wouldn't I move location to be able to benefit from cheaper housing, but not only that, cheaper bills as well? So the ability we've got now is that we don't have to pay commuting costs. That's perfect. But we can reduce other costs because we can work from home. So it might be costs, it might be things like council tax, for example, and that makes it very attractive, and it means that you can become financially independent. This is a real thing for the financially independent or FIRE movement, this idea of geo-arbitrage, and you may be able to retire far sooner. But the one thing I want to point out to people as well, this idea of can you move location and be much happier because you live somewhere that might be a nicer place, but you'd be better off, more affluent, because you maybe release equity, or you don't have a bigger mortgage, or you just have a bigger property. You might be able to save on your costs. You might be able to pay cheaper gym memberships or whatever it is. And geo-arbitrage works on your earnings too. So it is possible to make more money doing the same job in different locations. It could be you become a doctor in a location where there is a real demand for doctors, as opposed to somewhere maybe in a city where there are plenty of doctors. And so you can actually do the same job, but go somewhere where there is more demand for it and less supply, earn more as a result, pay less in terms of housing and maybe bills, and suddenly your financial position changes dramatically. And of course, we get people who do this who emigrate to places like Australia, where there's a demand for maybe nurses or particular job types. So I just want to throw it out there. We are now at a point in society where taking advantage of this idea of geo-arbitrage, we're probably doing it accidentally, but we're actually at a point where we are more able to take advantage. So just think about that as a concept. When you're sitting down at home and you're talking to your other half about money, could just simply moving location mean that you could earn more money, be wealthier that way, cut costs, and therefore that difference, the key thing is when that difference, the money that you save or better off, you then put into investment, into saving for your future, and therefore you in time could have a retirement sooner, or just have a more enjoyable, happier lifestyle.
Okay, so that's it for this week. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. You can get in touch with me if you need to as well. Don't know why you'd want to, but my email address is andy at moneytothemasses.com.
So that is it for this week, Andy. Of course, as ever, do review the podcast, because the reviews make a big difference to not only where we are in the iTunes charts and the various charts on different podcast apps, but also our own team morale. So that is it for this week. Until next time.
Until next time.